Welcome back, my good friends, and this is the TJ Tribe show that you're joining us, and you asked a question and we get to answer them. Somebody asked the question, TJ, what are the tax implications of property investment in South Africa? Woo-hoo! Aren't we all worried about tax, right? We are. So I am just going to break it down to you. But I also just want to stress out maybe a couple of things here before I jump into us talking about taxes. Number one, I'm not a tax practitioner, so I would highly urge you to go and look or engage a tax practitioner as and when your business becomes bigger. In my businesses, we have bookkeepers that look after our accounting. Secondly, we've got accountants that look after our accounting. Thirdly, we do have tax practitioners, CFOs, that look after to make sure that we are being compliant, because lots of things change. But I'm going to speak to you here on this here so that we can be able to understand it better. However, I'm going to start talking about this from a person. So there's around about 4 or 5 taxes that we all need to worry about. I think somebody said to me at one point, hey, there's certain things that will always happen in life. It's death and taxes. So here we are today, we're talking about taxes, and I just want to jump in here so that we can talk about it. If we are meeting for the first time, my name is TJ, your host, and I'm a former banker and founder here at the TJ Tribe. And I do business with a focus in student accommodation, flips, which is buy and sell, and coaching, with the hope that all of us as young upcoming modern parents, we can be able to have passive income from real estate. Welcome to the channel. The first one is that I'll speak to this one at a high level. This is around personal taxes. You own a property in your name, and which we don't advocate for here, which is why I want to fly you through. I do not want to leave you behind and say, TJ, but we never spoke about this, but you also used to have properties back in the days in your personal name before you got clever, and how come you are holding back? So I'm not going to hold back. I'm just going to give you the full shebang. The first one is that because we are in the buy-to-let business, property investments is about buy-to-let, right? And also, yes, we do here flips here and there. So what is the number one tax? The number one tax that as a person that you're going to pay, you own a property in your personal name, is what we call rental income tax. So any income over and above rental is taxed. So if you are to have a rental income, then you are also going to be taxed. So any rental income you earn is considered taxable income. Now you need obviously an accountant or a tax practitioner who can then be able to deduct all of these things. There is some other, there is good news, right? You don't have to pay the full amount, but there is good news. And the good news is that you can deduct certain expenses like maintenance, property management fees, insurance, cell phones, even the interest on the bond. These are all expenses, so they're taxable amounts. However, like I mentioned, speak to your accountant or to a tax practitioner so that for that financial year, I remember at one point in our personal bond, we put it in, I think it was last year or the year before, we put in the interest on our bond, and SARS said no, it's no longer deductible. And I was like, really? So it was the recent information at that particular time. So rental income tax, number one. So that's the first one. The second one is capital gains tax, right? I think many of us, we are scared of this one. TJ, we can't do this because of capital gains tax. I'm going to ask you a question. Before you were employed, did you even worry about taxes? Do you even know that there was a word called tax? You didn't, listen. So why are we worried? It's part of the game. But anyway, we're not here to talk about personal stuff. We want to jump into the business part of it. So Capital gains tax, CGT, is something that is always going to be there. This is capital gains tax is generally applicable when you sell a property for a profit. So you're liable for the capital gains tax of it. The taxable gain is calculated by subtracting obviously the base cost of the properties, subtracting all of the other expenses. So if you renovated the property, if you did an eviction, you had all your expenses, you put them in there, bingo, the capital gains tax is then calculated on a percentage of that. Transfer duty is also a tax, right? So when you're buying properties in your personal name, there is transfer duties. We all paid that without even complaining. And I wonder why people also complain around capital gains tax. It is what it is. So what is transfer duty? Transfer duty is when purchasing a property, you also need to consider the fact that there is transfer duty. It's a once-off tax payable SARS base. And within that, you generally pay that via the attorney. So obviously, it's a once-off. We don't need to pay it all the time. Now, for some of you, we also need to look at what is called value-added tax. In recent news, they've been talking about increasing it, whether they increase it 1% or 2%. I saw that the Americans, they were saying that they want to reduce theirs. I don't know if they have. I don't do any business in that market. But it's amazing, how some of these countries look at things differently. Others are increasing, others are reducing. So there you are. So VAT can come into play, particularly if you're involved in the property development or in the flipping. This is in your personal name. So let's jump on to talk about all of these things when it comes to a business. Again, welcome back to the show if you're joining us for the first time. We do this every Mondays here at the TJ Tribe. We just share notes between ourselves, what we are seeing in the market, how can we be better people. As we are in the month of March, what I'm going to be doing, my good friends, is that we are continuing with the competition. And in the comments, my good friends, all you need to do is type in the word March, and you stand a chance to win my book. This is my book that I wrote, my first ever book that I wrote, which is called From Bad Debt to Property Mogul in 2 years. And this book is available. And for you to win this book, what do you need to do? All you need to do is in the comments, type in the word March, and then thereafter with any comment, and we will do a competition. We'll draw a competition by the end of March, and we'll see who have won the book. We will be announcing the winners for February in no time. If you're in property investment, at some point or the other, you have had to evict someone. And I know, my friends, it is a painful exercise. But I'm here to tell you that for the last couple of years, I've been using a company that is called Expello. Expello, basically what they do is that you pay them a monthly fee. And over and above that, whenever you get a delinquent tenant, they will come and evict that individual free of charge, because obviously you've been paying, right? And over and above that, you don't have to do anything. But guess what? I have managed to organize a good price for you. And the link here that you're seeing, which is called expello.link./TJ Tribe, gets you a great discount from Expello. So my friends, don't be caught with your pants down on your tenant. Just Expello them with Expello. It is TJ. Let's go back to the video. So here we go. Let's dive in to talk about tax implications for companies. And again, I want to emphasize, my good friends, look for a good accountant. There's many people there that are accountants, but look for a good accountant. The first one I want to speak to you about is what they refer to as corporate income tax on rental income. So there's a corporate income tax, and for any business, your business is an entity now. It earns some income, so for that reason, it is charged an income. There's a deductible there. So for companies, rental income is part of your taxable income. So if your business is 100% on rental income, that income is deductible. Does it make sense? So in South Africa, the rate is generally for companies is typically up to around about 28%. So it's within that range of up to 28% of the profits. Ooh, I like that, right? As a person, your tax bracket is potentially up to 45%. So whatever rental income that you're getting thereafter, you are banking, or should I say you're going to be taxed 45% of that. So does it make sense? It doesn't make sense for me to own properties in your personal name. As an example, if I owned a property and I'm making, let's say, 10 grand in my personal capacity and 10 grand in my company, you'd see that just by mentioning this two income tax rates, you'll see that by the end of the day, the one person who is on a personal is going to walk away with less moolah in their pocket, and the one who is running this as a business is going to walk away with more moolah in their pocket in the business, right? So why would you want to do that? I don't know, but this is what we advocate here at the TJ Tribe. We're always doing it. Anybody can do it. Now, tax implication number 2. Remember, somebody asked us, TJ, what is the tax implications of doing properties? So the first one is that the first one which you spoke about is income. The second one now is capital gains tax. Whew. Right. Now here is the difference. If you've been watching right at the beginning, so capital gains tax, if you are staying on that property, there's a different way in which they calculate. They give you the benefit that you've been staying on that property. But companies, they don't have that. So when your company sells a profit, when a company sells a property for a profit, that gain, the profit that we're talking about, is then subjected to capital gains tax. So unlike individuals, companies don't benefit from the primary residence exemption because company is not a person, it didn't stay in that property, isn't right? Although I had an argument with my accountant at one point. I said, but the company had a domicile and the company was staying at that property. It was the only property that we had. And I went back and forth, but that didn't fly with my accountant. He says, TJ, you're being a little bit technically here, and all you're wanting is to make mumula. I was like, I don't know. I'm trying to read here between the lines on what it's saying. But nonetheless, obviously, my accountant then kept me straight and narrow, and we're able to do that paperwork. Now, here is the thing. Again, on capital gains tax, it's not just the profit that you're going to declare, but obviously you need to subtract all the improvements, their deductibles, and all the improvements, all the expenses. And with that, my good friends, we can be able now to reduce that tax burden. The next one is depreciation and deduction. This was very confusing for me at the beginning. Because I couldn't understand why when we say that property appreciates, now when we're talking about accounting, there's a depreciation now, right? I'm like, so does my property as, from an accounting perspective, does it ever have a zero value at some point if I'm to hold this property, let's say, for 100 years? So one major advantage is for companies is the ability to claim depreciation on property improvements. Right, so this non-cash deductions helps reduce your taxable income over the life of the asset. So these are improvements that we're talking about here, right? So for instance, a door, right? It's got a lifespan. The window maybe. So there's many things that we can need to include within this. But working with clever people, they can help us to navigate all of this. So make sure all of your expenses in your businesses are clearly documented. We work with the cool accountants. We work on zero for every expense that we do. They ask us to take a picture. They've got an app in which it uploads there, and it's just clear. What was this 1,000 for? There it was. Okay, TJ went for lunch. What was that expense for? Oh, it was 100. TJ bought a bucket of ice cream. What was that one? 20 rand. It was a 20 liter of paint, right? I'm just giving you examples here so that you can be clever in your business. The last one that I want to speak to you about, my good friends, is that it is called the VAT. VAT here, my good friends, value added tax. If your property investments activities is on the other side for development or large scale property management, and then it pushes over your amount, I think it's about $1 million now if I'm not mistaken, the SARS forces us now, or it gives us an option to be VAT registered. So it's called a VAT registration threshold. So you go above that in terms of turnover, you need to be VAT registered. And in some cases, you might be able to buy properties, and that property is also VAT registered, and in your you might be VAT registered. So it works out in your favor in both ways. Now there could be many other. Right, these are the stuff that I'm just speaking about. If you had to Google them, you'll be able to walk with it one by one and understand it. Our goal here at the TJ Tribe is to ensure that modern parents like you can then be able to earn alternative income. But a lot of taxes, a lot of money go into taxes. So we want you to be aware, because we are also aware in our businesses of all these other expenses, because they're going to take away some of these incomes to you, and you're assuming that you have this money when you don't. You now need to pay SARS at a later stage. But don't forget, there's other costs like transfer duty. I didn't speak about it when I spoke about it in a personal capacity. When you're acquiring a property, it's a once-off fee, but again, it's a tax implication, right? So while not it being a recurring tax amount, it's something that we need to factor in. If you're buying a property for let's say 2 million rand, there's an above of a plus minus 200,000 in taxes and transfers that is needed. It just doesn't fall from the tree. So I want to give you this tip. The reason I did this video is to give you this tip. One of my greatest teachers, Robert Kiyosaki, indicated that if you are to work with a team of people, property investments becomes easier. One of those team members that he speaks about is the bank. One of them is a politician. I haven't found one yet. I'm still looking for a friend. But the other one is a tax specialist. Now, I have seen over the years that having this person on the team and also an accountant is very important, because they know tax strategies that we don't know, right? And sometimes there's so much money that you can save on within this year, and sometimes there's so much money that you can play around with, but they can give you direction as your business starts to grow. Obviously, this person doesn't come cheap, but they are a key resource in your team. Just like you have a legal person, an attorney on your team, that person is also as key as this. I hope this has been able to give you some value. Do not forget to enter into the competition so that you can win my book, which is called From Bad Debt to Property Mogul. This book here, it will give you some insights on how you can start. I wrote this book not so long ago, in 2019 it was, and you can win this book by the end of this March. All you need to do is just to comment March, and then you give us a comment or maybe ask a question. Follow through on these things. But don't forget, my good friends, here at the TJ Tribe, we are here to help one another. So your comments helps us to become better. Someone else is going to read this and like, oh, okay, it makes sense. Or I'm going to read that and I'm going to like endorse it, like, yay. Or we're going to ask the question and I'm going to be able to answer it on our next video, and all of us will become better. Until we see each other again on the next video, it is I, your boy, TJ.